Alright, what's up everybody? This is Adam here again at engineeringsolve.com. What's up everybody? This is Adam here again at engineeringsolve.com. I got a little bit more complex retirement calculator for you with a Monte-Carlo simulation based on the efficient market hypothesis, which you guys can all look up if you want to. It's kind of a debatable hypothesis. It's kind of like the behavioral finance side versus the EMH, efficient market hypothesis, and they're kind of two competing views. But you guys can get into that on your own if you like. Maybe I'll make another tool to like compare the two. But at this stage, we're assuming that the investor behavior is always optimal in all cases, and that's the main argument for behavioral finance, is that it's not. But we're gonna forget about that half of it. We're just gonna focus on the EMH. So here we have basically just an input spreadsheet here with general information based on your age, your goals, your risk tolerance, and then also your current retirement balances, and then savings rates, and then maybe a few decisions as well. Before I get into this tool, what this tool does is it'll run thousands and thousands of Monte Carlo simulations at once, and if you hit run analysis, this button here, you have to wait a few minutes, and down here at the bottom right in this area, it may say data table 1, data table 2, 3, 4, 5, 6, all the way up to about 11 or 12. So it may take, depending on your computer speed, you may want to keep in mind that you hit run analysis and then you just wait it out for a minute or two, and then it will go to the results tab. So keep that in mind. And one other thing too, to speed things up, is you want to turn off, before we get going, you want to turn off the automatic calculator here, and you want to do manual. Click manual and then hit OK, and that way every time you change an input over on this side or here, it will wait until you click run analysis, because each time you change a variable, it will restart the data tables, and that'll really be frustrating. So you definitely want to make sure you go into the options and turn off the automatic calculator. Okay, let's get in the tool now. So again, similar to my prior tool, more simple tool. Let's say the current year as of this recording is 2016. The current month is July, and it's currently July 2016 as of this recording. Let's say, let's say you're 24 years old. You want to retire at, 55. You want to retire a little early. Beginning Social Security. This factor is, honestly, it's really meaningless to this tool. You could put whatever you want. You could delete it. You could put 0. There's really no basis. At some point in the future, I may build this in as an additional feature, but it's not active at this stage. Okay, so you're 24. Your current gross salary is $45,000 a year. Your effective tax rate, now this isn't your tax rate as in the U.S. I'm speaking from a U.S. perspective here. This isn't your really tax rate. This is your effective tax rate minus all of your deductions. Say you're young, you don't have a lot of assets, and you use the standard deduction each year, then your effective tax rate will be much less than your actual tax rate from your paycheck. So let's keep that maybe 15%. Maybe it's lower, maybe it's 12%. I don't know, maybe your retirement tax rate may go up a little bit. It's possible. It could go down, could go up, but we'll assume it goes up. Let's say retire early if the option arises. Well, of course. Yeah, of course. If I save a lot or if the markets do very well, of course I want to retire early. Why would I keep working if I didn't have to? So let's leave that at yes. The investment style, again, this is related to the risk capacity versus your risk tolerance. This feature here is basically your risk tolerance. Say you're aggressive, you're moderate, or you're safe. But you're young, you're a go-getter again. You want to go make something out of yourself. Let's say you're aggressive. Say, I want to do this. Let's go after it, right? Let's be aggressive and go after it. Here we have your desired max annual withdrawal rate after retirement. So when you retire, you have X amount in all of your accounts. And this is like the 4% rule that you may have heard about. I am no financial expert. This tool, despite its complexity, it is not a replacement for a financial advisor or anything of that sort. I am not a financial professional, and this tool is for very general use only. It is not intended to make official decisions in your portfolio. So please keep that in mind. Let's say, so it's a debatable thing, but this is like your 4% rule. You could do 3%. Say you have $1 million in retirement and you make, I don't know, $50,000 a year, and you want to take out $30,000 a year after that. So that would be 3%. Let's keep it at 4. And then your desired income replacement. So again, if let's say you make $50,000 at retirement age, you want to take out 90% of that. So that would be $45,000 a year. The lower this value is, the more the worse, I guess I would say. It's not a good word, but the worse it is. A quick and dirty rule of thumb too is if you divide your income replacement percentage divided by your withdrawal rate percentage. So let's say you want 80% income replacement after retirement. So if you divide 80% divided by 4% is 20. So if you take your pre-retirement working income, multiply that times 20, that will give you a rough estimate of whether you're ready to retire or not. It's totally independent of Social Security. So keep that in mind. Let's leave that at 80%. Ideally, I mean, you could jack this way down at 3%, and let's say you want to live in luxury at 110%. Say you want to go on a lot of trips around the world, do whatever, visit family, visit grandkids. So then your ratio goes up a lot. It's 1.1 divided by 0.03, which is, I don't know, what is that? 33, 35, something like that. So then you need 33 times your income rather than 20 times your income. But for argument's sake, let's leave it at 4% and 80%. Right now, let's say, moving over to the balances, let's say you have $1,000 saved in a Roth 401k. Let's say your company offers that option, which is a nice option if it's available to you. Let's say you currently put in 10% a year. The company match, if the company provides a match, it's always taxable. Always. Despite whether you put it in a taxable 401k or a Roth 401k, the match is always taxable. So keep that in mind. So I've crossed that out and left it at 0 as a reminder. Let's say, okay, each year you get let's say you get a 3% raise to match inflation, and you want to take 1% and add that to your contribution rate. So in year 1, you'll put in 10%. In year 2, you get a 3% raise. So 1% of that goes into your retirement. So you bump it up to 11, and then you keep 2% in your paycheck. And then you do that throughout your career. So eventually you'll bump this up. After 10 years, you would have doubled your savings rate. So that's what it's doing in the background. Let's say, okay, go back to this. So let's say you've been a good saver. Let's say in high school you worked a lot and your parents kind of steered you in the right direction and said, hey Junior, why don't you open a Roth IRA, and since you got some income, let's put some in there. You'll thank me later. I know you probably don't want to do it, but you'll thank me later. Just trust me. And you went ahead and did that, and now look, you have maybe $2,500 in your Roth IRA. And you currently contribute maybe $100 a month. And then say next year you want to put in $150,000 a month. No, that's crazy. Another $50 a month, so $150 a month. And then year 3, you'd put in $200 a month and $250 a month each year. So that's what this annual rate increase to maximum. Now the current maximum in 2016 in the U.S. is $5,500 a year per person, and that's about $458 a month. So I think I have built in that limitation in this tool, but I have not in the other simpler retirement calculator tool that you can also find on my website under the economics section. Let's say taxable accounts. Let's say you've foregone the taxable 401k for the Roth version up here. If the companies do offer it, you could do 50-50, you could do 25-75. You could split it up, you can do all in one and none in the other. But let's say you decided to do all in the Roth portion of your 401k and none in the regular 401k, the taxable 401k. So your contribution rate on that would be 0. But your company match, say if you put in 3%, if you put in 10%, they'll put in 3%, or they'll do dollar for dollar up to 3%, and then after that they max out at 3%. So let's say you put in 10 and they put in 3. If you put in 5, they'll still put in 3. That kind of deal. So they'll put in 3. Let's leave that at that. And then this annual rate increase to max is associated with this current contribution rate. So you don't want to increase your taxable 401k amount. You want to increase your Roth 401k amount. But the company match is still going to be taxable all the time, every time. Okay, so now your balance for your traditional IRA or a rollover IRA, if you've been in multiple jobs, say you're a mid-career, you worked a few places, you had taxable 401ks elsewhere that you've rolled over into a traditional / rollover IRA, then you could put that balance here. But you're starting out, you don't have that yet. Let's put that at 0. And then say you have a traditional IRA. You put in X amount per month, but you don't have that either. You just do the Roth option. And then you don't want to increase it because you want to increase the Roth option. And then this is a brokerage account. This is basically, I don't know if, me personally, I don't consider this as part of my retirement, but you may want to. Let's say you have $500 in there just as like some play money. And then you add in $25 a month to buy a stock or two, whatever you want, So let's leave that at that. And then here it says you can make it catch-up contributions at age 50. So in that case, so I believe in 2016, your maximum 401k contribution per person is $18,000 a year, I believe. And for IRAs, both Roth and traditional, are $5,500 a year. So that's $23,500 a year per person. But at age 50, I believe, or 51, I think it's 50. You can add in, I think, $1,000 more per year on the IRA side and like $5,000 a year on the 401k side. Don't quote me on that. It's something like that. So let's say you're a slow saver and you got to make up some time. That's a nice option to have at age 50 and above. So at this point, we're all set. We got all of our data entered, and we would hit Run Analysis with this button. And you can see here, it slows down a bit. It's calculating down here at the bottom. I may cut this out and fast forward a few minutes. Okay, calculating. All right, there we go. That was quick. All right, so it takes you right to the results page here, and it says chance of retiring by age 55, which is the age that you entered previously, is almost 91%, which is pretty good. Congratulations. That's a pretty good percentage. And then it says here, percent certainty retiring by this age. So by age 48, you have a 50% chance that you'll be ready to retire. Let's say you have enough money saved, and based on the growth of your income per the inflation rate, then you have a good chance. 50-50 shot at 48. That's pretty young. And obviously you may have other concerns at that age, maybe like healthcare or insurance or anything like that. That may complicate things, but that's beyond this tool for sure. And then here, this nice chart here, chance of reaching a given portfolio size by age is, so here you have portfolio size, 100,000, 500,000, 1 million, 2 million, 5 million. Based on the inputs you've provided, you would have a 25% chance at age 40 of having $750,000 in your retirement account. Or by age 48, you would have a 90% chance of having $1 million in your retirement account. So here, all of these green cells are good. Basically, you're ahead of schedule. And then here is your brown cell, 55. That's the age that you've selected. That's brown, so that's right on target. So you have a 90% chance of $2 million at age 55. And here's 90% at age 55. And at that point over here, you would have around $2 million. And that would be sufficient at that age for you to retire. And then here, above that, you would have 75% chance at age 60 of having $4 million if you kept working. So anything in here, anything red is beyond the retirement age. So you could retire at this age, but say you want to keep working, and you'd be fine. But this is like the cutoff. So you have a 95% chance by age 49. You have a very, very, very high probability of having $1 million at age 49. And if you kept working, you'd have a very, very high probability at age 72 of having $5 million. But conversely, you'd have a very, very, very low probability of having $5 million at age 53, which is young. I mean, the markets would have to be outstanding, most likely, for you to reach that target based on the inputs you've given. And then also down here, this chart, it will plot your portfolio in millions of dollars per age and based on the probability percentages. So Here, the blue lines are your highly likely scenarios, so they're a little bit lower, a little bit more conservative. And then your less likely, higher amounts per age are in red over here. So these are, the blue ones are more likely to occur, and the red ones are less likely to occur. So they'll be, so at age 50, you know, you'll have 50-50 shot of having $2 million. And then here, let's check that out. So $2 million at age 50 is a 50-50 shot right here. And you can see that from the graph here, 50 up to 50% chance here is 2 million. So these correlate. The graph and the table correlate. And now here, what I've explained earlier is the risk tolerance versus the risk capacity. So this is just a very, very qualitative chart that I've created based on the inputs in the prior screen. In that, let's say you have a very high risk tolerance. Actually, I believe these should be switched. So this would be, you're kind of reckless if you have a risk tolerance very high and you're older. So those should probably be switched. Older is on top and younger is on bottom. Because let's say you're very, very old, you have a very high risk tolerance, but a low risk capacity because you're older. As you're younger, your risk capacity is greater. As you increase in age, your risk capacity is lower. And then here's your target zone. You want to be an appropriate amount of risk capacity for tolerance based on your age. So if you're young and have a low tolerance for risk, you're being kind of timid, honestly. You could probably take a little bit more risk and be okay. And then conversely, if you're very old and you have a very, if you're old, you'd be on the left side of the graph. And if you have a very high risk tolerance, you would be kind of reckless because you don't have a lot of time left to make up any significant losses. But the target is you want to kind of be balanced in the middle here. This is all qualitative. This is a nice little thing that I've made up, but it's something to keep in mind. And if you're interested, you can go and see the calculations on this sheet. So here we have the year, we have your age, we have historical data here for the market returns. And then we have the Monte-Carlo simulation based on that. How many trials do we have? We have about 2,500 trials. And then it does a normal distribution to figure out all of these variables or these results in percentages. And then we can go see the calculations. That's just the raw calculations. So here, what I mentioned earlier, the maximum per year is 18,000, 5,500, and it's increased with inflation. I think in $500 increments. I believe it's based on the CPI, if I'm not mistaken. And you can override these yellow values if you like. You could really override anything you want, honestly. If you know what you're doing, if you can figure out the formulas. But I would mainly stick with these yellow values. I've just assumed that every 5 years it goes up $500. I don't know, you can fix that if you like, but then we have kind of a step down approach, kind of like a pseudo, what do they call it? One of those mutual funds called the target date mutual funds. It's like a pseudo target date where the stocks and bond mix changes over time, and therefore the return gradually decreases theoretically at least. It's kind of a pseudo factor built in for that. And then we go back to the input, and that's about it. So yeah, that's about it, guys. I hope you like the tool. I put a whole lot of thought and effort into this. Oh, and one more thing. This column here has some if-then statements. So as you update things and then run it and then go back to the results, it will change suggestions and just general suggestions. Nothing that should be held on to tightly. So yeah, that's about it. Hope you like the tool. You can visit my site, engineeringsolve.com, and click on the economics category. You can find this tool free for download. Check it out. Thanks.